Okay, students, we're going to cover chapter 13 now. This is a chapter on the exit plan, or what the authors call planning for the harvest, or the harvest plan. But anytime you have a company, you need to be thinking about what do we do to harvest the value that we're creating with this company. And so there's a number of ways that you can look at toward doing that. And so we'll talk about some of these right now. As you begin to think about planning for the harvest, there are certain things there are certain, alternatives you can take or paths you can take, and generally they're fairly limited in what you can do. The harvesting or exiting process, look at kind of down toward the bottom of this chart right here, I guess the middle of the chart right there, really involves three things, or three areas of consideration, the things you got to think about. Capturing the value, the cash value, or the value you want to get out of your company, reducing the risk that you have when you do that, and then creating future options for yourself. So you have to think about that process, or that thinking cycle that you have to go through. So as you begin to roll off your wheelbarrow full of cash from selling your company or whatever you do, then you got to think about what am I going to do with that cash, or what am I going to do with my life sometimes. And so, in fact, I have a friend who was involved in a very extremely successful high-tech startup company a number of years ago. He retired at age 43. I mean, fixed for life. So what do you do in a situation like that? So every person needs to have purpose in their life, and fortunately he had a very important purpose and has accomplished a lot of things since then. And sometimes, again, if we have some chance to talk, we can talk about that. So let's see what some of the things are that we can do. These are our basic options for harvesting. And there's really only about three for harvesting. I can sell the company, and we'll talk about those options there in just a moment. I can begin to take cash out of the company. That's what we call distributing the cash flows. Or I can sell stock in the company, which is a form of selling the company, or a form of selling a portion of the company. And I can either sell that stock publicly, which is what this bubble's about, or I can sell it privately, which is that bubble right there. And we're going to give you some examples of this and of selling the company here in just a little bit as we move forward. Now, you're going to have a more detailed definition here in just a moment, but let's talk just a little bit, just with common terminology, about what is a strategic sale, what is a financial sale, and then we'll show you an example of sales to employees here in just a little bit. On a strategic sale, basically what I'm doing is I'm selling my company to another company that sees my product line or my company as a valuable asset. It plugs a key gap in their product line or in their strategy or thing in their customer outreach or market outreach. This strategic sale says that when I bring my company that I'm selling into this other company, it's a long-term strategy that my company fits. Not only can it stand alone, in other words, generate its own profits, but it's going to enhance all the profits of my company. A financial sale is a little bit different because it's purely financial. It's a situation where the purchaser says, I can buy this company and it will support itself, or I can sell off some assets that will allow me to perhaps reduce the leverage ratio that I have in my company. And so that's kind of the two approaches. Strategic sale, you can think of the word synergism with that. Financial sales, you can think of the word assets or the word of cash generation with that. Then we can talk about sales to employees, and that's something we can look at here in just a little bit. Now, this is the formal definition of strategic sale versus financial sale, and you can read those as well as I can. These charts are in doc sharing on eCollege, and so you can take a look at that. But this is the formal definition of the strategic sale and the formal definition of the financial sale. Now, in a financial acquisition, you typically are talking about a leveraged buyout. One thing I didn't tell you a moment ago was that in a financial sale, they typically are always leveraged. That means that they are purchased using debt, and they typically are leveraged as far as they can possibly be leveraged and still survive. So on a leveraged buyout, you typically got maximum debt there. And then there can be either a bust-up LBO or a build-up LBO. The build-up LBO is one where I'm going to take the company and I'm going to build it up and grow it into something really good because it's generating cash, it's generating a profit, and so it has a chance to really become something special. A bust-up LBO is where I'm going to sell off parts of the company to raise money to alleviate some of the leverage, in other words, to pay off some of the debt. Most often, this is the type of sale that a financial acquisition will be, a bust-up LBO. I'm going to leverage the company to buy it. As soon as I buy it, I'm going to start selling off divisions or selling off key assets to get my leverage ratios back in line to something that's normal. Now, we can also do management buyouts. In fact, I have a friend who runs a company that helps with this type of buyouts. They help management teams to buy out their companies. And so that's pretty common as well. And we'll look at a way to sell companies to employees here in just a little bit. Now, here are some characteristics of a company that fits into the LBO category, the leveraged buyout category. It's a company that has steady earnings over time. It's an attractive growth rate for the company. In other words, it hasn't been declining, but it's been growing, and sometimes the growth can just be steady or it can be very, very fast, but nevertheless there is growth and it's been sustained for a while. You have a very effective management team, and you have some assets that are useful for collateral. So those are characteristics of a potential LBO purchase. This friend I was telling you about, their company comes in and buys companies like we see right here. They have steady earnings, typically small manufacturing companies. They've had a steady growth rate and have potential to do much more. They have a good management team in place, and so my friend's company will come in, finance this sale, put the management team in charge, and then let the company begin operating for several years, and after several years they'll either sell part or all of the company off to a buyer. I can also sell to my employees, and here is an example of an employee sale that we call the employee stock ownership plan example. This is a method where the owner can sell his company to the employees and provide benefits for the employees and benefits for himself as well in the process. The first thing that happens in this case right here, and we show these steps up here, 1, 2, 3, 4, and so forth. But really the first thing that happens is the company sets up an ESOP trust, an employee stock ownership plan trust. And that trust is set up to buy stock to award to the employees based upon years of service or based upon their total salary or based upon whatever the scale is the company wants to use. They set up these trusts to do that, and the trust each year will get money from the company. They'll go buy company stock, and they award the stock out to the employees based upon some formula that they've come up with. Typically, the ESOP is a separate legal entity, and it has 3 trustees, and those 3 trustees typically are officers of the company. So what happens now then? So the second thing that happens is the ESOP trust wants to borrow money from the lender. And so from a lender, not from the employer. So what happens is the employer agrees to guarantee the loan. What that means is the ESOP trust goes to a bank or to some other agency that wants to lend money. The employer steps up and says, our company will guarantee this loan. And so the ESOP trust takes on the loan, and then they immediately go to buy stock from the owner. So what's going on here? The owner's trying to sell the company to employees. And this is exactly what's happening. So then he buys that cash is used to buy stock from the owner. That stock then goes into the ESOP trust, and then it is sent to the employees for their benefit. So once the stock goes into the trust, it's distributed to the employees for their benefit, and there will be certain formulas that the company has for doing that, wages, seniority, whatever. But they'll use that formula. Everybody operates under the same formula. So the ESOP has the stock. They then distribute it out to the employees at year end or whenever their review process kicks in. So then what goes on is the company has guaranteed the loan. The loan has been made by the trust. And so now the employer begins to make continues to make their annual contribution to the ESOP trust to buy stock with. And the ESOP trust now has set up a way to make payments on the loan. And so it's a pretty good deal for the employees, because what happens when you work through this entire process is the employees end up owning the company. That's a good deal. Now, if you're going to sell your business, you got to get things cleaned up. You want to clean up your books. You want to keep your revenue strong. You don't want to do anything to damage the process. You want to keep it growing as much as you can, and make sure you understand your sector and your market that you're operating in. Always really important. Now, we talked about earlier about distributing the firm's cash flows. What that means is I'm going to start taking cash out of my company. And so you got to be careful about that, what that really does for you. There's advantages and disadvantages. One of the advantages is I can retain control of my company while I'm harvesting the investment. So I've built up a value in my company. I'm going to harvest some of that money and put it in my private bank account. Perfectly legal, perfectly okay thing to do, but you got to be careful about it. The advantages of that is that you don't need to seek a buyer or go through the process of trying to sell stock. The disadvantages are that you lose some of your capital investment potential because you're dwindling it down, moving it into your personal account. There's some tax disadvantages for cash type deals, and it requires a very slow, patient siphoning off in order to get to the cash levels that you would like to get to. So there's pluses and minuses with distributing the firm's cash flows. I personally don't like that very much because you like to see companies grow, and if you're going to have to sell a company or buy a company for growth reasons, then you want you don't want to be taking money out of it right now. You just let the company reward you with whatever value you get for the sale. An IPO is where I'm going to sell shares of my stock to the public. And you can see here the advantages. There's benefits to that. There's good signals that come out of that because before I can IPO, I've got to have a functioning company. And I've got to have a company that has a track record. And then the question you ask yourself as an owner is, how do I know when I can do an IPO? Well, trust me, there are people in the marketplace who can tell you when it's okay to do an IPO, and they're typically called investment banks. You'll see in a moment that's one of the things that if you're going to IPO your company, it's one of the things that you're going to want to hire as an investment banker. So then what that does, though, if I'm IPO ready, is it signals to the investors in my firm is it's a quality business and has a chance to perform well in the future. It signals that I can have access to more investors when the firm needs to raise some capital. In other words, investors will take note of what I'm doing and they'll check me out, and I can maybe have a chance to sell some of them. It creates ongoing interest in the company because I'm selling stock. People buy the stock. They want to make money on the stock. Their ability to make money on the stock depends upon my ability to generate profits and to grow sales. And so there's just all kinds of things at play here, but there's also kind of these external things that we talked about in this little list right here. Now, if you look at a chart of the IPOs between the first quarter of 2007 and the third quarter of 2010, you can see that there was a huge dip in the IPOs from about first quarter 2008, fourth quarter 2007 to first quarter 2008, and it really continues till today. It hasn't come back up to the levels that it was before the Depression. We had the second Great Depression hit about 2007 and 2008, and so you can see the impacts of that in the IPO market. The IPO market has not yet come back to the levels it was. So if I'm going to go public, then there's a process I go through, and these are the major steps. And needless to say, there's 1,000 other steps here that aren't mentioned, but they're all part of these 8 majors. So the first thing I have to do is decide if I want to go public. That's a big decision in today's world. In fact, I recommend to companies that they not go public unless they have to raise the capital. And that gets me to another point. The primary reason of going public with the sale of your stock is to raise capital for your company, to grow your company. Also understand that I do not sell all of my stock in a public offering. I can sell whatever proportion of it that I want to sell in the public offering. So that is a strategy development process unto itself. Now, if I'm going to sell, I've got to understand then that I've got to have audits in order for the last 3 years of my company. So I've got to make sure I have at least 3 years of financial statements of financial audits that have been done. I then select an investment banker, and generally you always do that. They're not cheap, they're expensive, but they will guide my company through the IPO process. I file an S-1 registration form with the SEC that tells them I'm planning to sell this much stock during this period of time, blah, blah, blah. And then they begin to try to exert their control in terms of regulations over what you can do. All perfectly well intentioned, some good, some bad. Now, then the next thing you do then is you present, after you've completed this S-1 registration, you respond to comments that the SEC, I'm sorry, go back. You have to complete an S1 registration file with SEC, and then you respond to those comments the SEC gives you, and you submit your red herring proposal or prospectus, or you publish your red herring prospectus. Basically, that's a little booklet that says this is what we plan to do, and oh, by the way, you can't hold us to any of this stuff. It's all just estimates, so don't buy any stock or sell any stock or do anything dangerous based upon what we're saying in this prospectus. So there's always disqualifiers in there, and so it's a preliminary prospectus and will get changed later. It's kind of a red herring, means I'm tossing it out there for people to see how the financial community is going to respond to it. Then the firm goes on the road. So the CEO and the CFO hit the road, and sometimes they'll be on the road as long as 30 days pitching this deal, this selling of the company stock. And this is where you find out if you're really making an impression with the big investment houses or not. And if you find out you are, then that's going to enhance the first day sales of the stock quite a bit. On the day before the public offering, then, the investment banker and you decide on the offering price for your company. At the opening bell, then that stock goes on sale, and shortly, within a day or two, we find out what the market thinks about the value of the stock, and the value will settle in to whatever the general market says this is the value of this stock. It's kind of a magic thing. But anyway, this is the way an IPO process unfolds. It's a lot of work. It takes sometimes as long as a year to pull it off. A lot of time away from the company for the CEO and CFO. It's just a lot of things there to think about. Now, you can also do private placements of your company's stock. That's where I'm going to allow private investors to invest in my company. Now, there are some factors also in the transfer of family-owned firms that you have to think about. I'm not going to spend a lot of time talking about this, but if you're in a family-owned firm, you'll learn very quickly. All of these things kick in. Liquidity for exiting family members, continued financing for company growth, maintenance of family control of the firm. All those things kick in as to how you're going to do that if you're transferring a family-owned firm. This can be a very, very complicated, nerve-wracking process for families that aren't used to it as well. In a private equity situation, you can have all kinds of deals prop up, but this is one. It's just a good example to talk about if you're not familiar with some of the more complex deals. This one is not really that complex, but it gives you kind of an inkling. If you get into the investment community, into financial services, I'm selling bonds, selling stocks, then you're going to have to begin to understand some of these deals that have been set up in order to properly advise your clients. But in this case here, I've got a small company over here that the owner wants to sell for $18 million, and here's the owner right here. We have a buyer come along that says, look, here's a deal I would like to structure for you. I want to buy $4 million of common stock. I want to buy $4 million of preferred stock. So let's define that stock, both types right now. Get it set up. I will write you a check for each one, and you can take both of these and then go to town with this company. In addition to that, I, the entrepreneur, am going to go borrow $7 million of money from the bank, which will become senior debt, and then I'm going to ask the owner here to pony up $3 million to the seller, just as a goodwill token. It's a token of goodwill, token that I mean what I say. So now what's happened here? I've got $4 million and $4 million. That's an $8 million investment. The owner had asked for $18 million. The new owner has acquired senior debt at $7 million, and so he's still $3 million short. So what does he do? He goes to the owner and say, Mr. Owner, would you float a note on this deal? And the owner typically will say yes. And so the owner then carries a note for $3 million. And so if I add these up, I'll see I've got $18 million. And so this seemingly little complicated deal has been put together to acquire the company, and it's fairly logical and fairly simple how it works. Now, it can get a lot more complicated. This is just one simple example, so kind of take note of that. Let me point out again where the resources come from. $8 million in stock, both common and preferred. Senior debt of $7 million, that's 15, and then $3 million owner's note, that is $18 million. And so that's the sale price right here. The owner didn't get a full 18, he got a $15 million plus a note. That's his ownership. Part of the challenge in harvesting is you got to value your company. How much value do I have here? There's basically three ways to do that. The cheapest and probably the most efficient way to do it is make it a multiple of earnings. The multiple of earnings way says that I'm going to take the EBITDA, the earnings before interest, taxes, depreciation, and amortization, and I'm going to multiply that number by whatever the corporate group, the business sector that I'm in, whatever their ratio is. Typically it'll be 5 or 6 or 7. And I'm going to multiply by that ratio, and that's going to give me a ballpark price of what my company's worth. It's amazing how this works, but it really works well, and it's very quick to do. And I can also do a net present value calculation, how much cash flows will I get if I buy this company versus how much money am I spending. So I can do that. Or I can do a comparable value comparison for another company that might have sold. So typically the last one is the least reliable because no two companies are exactly alike. Probably the best way to value is the simple and dirty, quick and dirty way, because you're going to end up negotiating the final price anyway. So the best thing you can do right now is on a very cheap basis, get a rough feel for what the company is worth and then proceed to the negotiating phase. Now you also have to think about payment alternatives. Do you want cash, stock, or do you want a merger with another firm? I mean, what are all the alternatives you have that you got to consider? Well, the nice thing about cash is it's very quick. I can just take cash and put it straight in my bank account. The bad thing about cash is I have to pay tax on it. Pardon me again, my throat is really acting up. Now, so I have to think about tax liability on cash, and that's always a big deal, particularly in today's world. There's a lot of a good accountant can help you with this, can help you kind of spread the cash out where you don't take such a big hit. Other ways of sheltering that cash. Stock is okay. If I'm the purchaser, the purchaser is going to want protection from liabilities. That's not a problem. Seller, I have an immediate value but uncontrollable value in my stock. That's generally called liquidity. And I may have potential problems with disposal of the stock, how I can sell the stock. So there's some downsides to stock as well. If I decide I'm going to merge with a purchasing firm, then there's also some issues there I'll have to deal with too, and that is basically, how do I get my value out of this merger? Because basically, a merger is, in its truest sense, is a sale, and so you have to decide as the owner how you get your value out of that merger. Now, if you're going to exit your company, you need to develop a harvest plan. So you got to anticipate it well ahead of time, manage for the long term, and avoid playing this harvest game of this is where I'm headed, I got to get there before I can sell the company. But put together a long-term plan and work to that long-term plan. So you're going to have to, once you start your company, once you've nursed that baby to wherever it is, there's going to be conflict in the sale process. There's going to be emotional conflict in your own mind for selling your company, and that always happens. Even in a larger company, I've had this experience of working with really an outstanding team, and then selling our company and realizing this team is going to break up, never to come back together again, and that's always a very emotional time. And then make sure you're getting good advice from your advisors, your investment bankers, your accountants, your attorneys. Make sure you're getting good advice there. Now the book has a lot of good suggestions for you. You want to make sure you understand your motives for exiting. Why am I getting out now? You want to make sure that you realize that your personal identity is separate from your business and you can live with that. And then avoid seller's remorse, regretting for selling. In fact, they kind of wrap it up really well in the text with this little statement right here. Whatever you decide to do it with passion and let your life benefit others in the process. Very good advice from the owners. You want to do whatever you're doing, do it with a passion, and then make sure that what you're doing is going to benefit others in the process. Really good. So this concludes Chapter 13. That's our last chapter lecture. And so now you're ready to go ahead to the Chapter 13 exam. So good luck to you on that.